Hi everybody. We've learned the concepts under Ind AS 12, income taxes. We would now like to apply that learning with the help of several questions to test our knowledge on the topic. We are provided with the question here. It says that an asset which costs 150 rupees has a carrying value of 100 rupees. Cumulative depreciation for tax purposes is 90 rupees and the tax rate is 25%. The requirement of the question is calculate the tax base and the deferred tax on the asset. Now, importantly, you would like to remind yourself of the definition of a tax base with respect to an asset. We refer to the tax base as amount deductible for tax purposes, right? That's a plain definition of a tax base for an asset, which is an amount that is deductible for tax purposes is the tax base for the particular asset. Now, importantly, we are provided that the cost of the asset is 150 rupees and the depreciation for tax purposes, which has already been charged, is 90 rupees, which means that the remaining value or the balance amount, which is 150 minus 90, that is 60, is something which is available as deduction in future, and that is where this will be reflected as a tax base of this particular asset, right? So that meets the requirement, the first requirement of our question in terms of the calculation of the tax base, right? Now, what we also is required to do is identify the deferred tax consequences on this particular asset, okay? Now, again, we go back to the question and we're given that the cost of the asset is 150 and the carrying value is 100, okay? So what we need to do is basically compare the carrying value and the tax base. The carrying value is given at 100 and the tax base is given at 60. Of course, the carrying value being the higher than the tax base, it simply means that while you would be charging depreciation in the books to the extent of 100 in future, the tax authorities will be giving you the reduction only to the extent of 60, which means that on the difference 40, you would land up paying taxes in future. You land up paying taxes in future, and that is where you would need to calculate a deferred tax liability. How do we calculate that? This difference, which is referred to as a temporary difference, we shall be calculating the temporary difference multiplied by the tax rate, and that is provided to us at 25%. It means that my deferred tax liability should be measured at 10. All right, let's have a look at the formal solution for this question. It says that the tax base of the asset is 60 rupees. We have calculated that 150 minus 90. And then it's mentioned to recover the carrying value of 100 rupees, the entity must earn a taxable income of 100, but would only be able to deduct the tax depreciation of 60 rupees, which means that we'll have to pay taxes on this difference of 100 minus 60. And what is the tax rate? Of course, it is given at 25%, right? And that's the reason why this temporary difference could be referred to as a taxable temporary difference, and a DTL, a deferred tax liability of 10 will be calculated on the same. And that's what is provided. Therefore, the entity recognizes the deferred tax liability of 10 rupees representing the taxes it will pay when it recovers the carrying amount of the asset. All right. Thank you very much. Let's have a look at this scenario. It suggests that Alpha Limited acquired 100% shareholding of Beta Limited on 1st of April 2016 for a consideration of 3,000 crore rupees. As at 31st of March 2020, Beta Limited made post-acquisition undistributed profits of 375 crores rupees. As per the tax jurisdiction, the tax base of the investment in Beta Limited is the original acquisition cost. Dividend distribution tax is 15%. The required notification is determine the deferred tax implications. Now, the two things that you want to understand here with the given information, that the tax base of the investment is the original acquisition cost, which means that in the books of Alpha, the tax base is 3,000 crores. All right. Now, the relationship between Alpha and Beta, as you would observe, is that Alpha has acquired 100% shares. It means that the Beta is a subsidiary, and whatever profit is earned by Beta, right, of course, would be attributable to Alpha. And there's no dividend being paid. It means that the value of the investment, carrying amount of the investment in the books of Alpha will be 3,000 plus 375, which makes it 3,375 crores of rupees, right? Now, essentially, the carrying value here and the tax base are different. And of course, in future, if Beta pays dividend, then this temporary difference will get reversed. So, ideally speaking, there should be a taxable temporary difference, and accordingly, a deferred tax liability recognized for the difference of 375 crores, right? It's a straightforward thought. But now you would need to remember the exception to the rule of the deferred tax liability recognition, right? The exception says that where the entity has control over the timing of reversal of the temporary difference, right? Alpha being a parent company can control on when should Beta pay that dividend. And that is where the reference of the control on the timing of the reversal of that temporary difference is concerned, right? Alpha can direct Beta to not pay dividend till the time it wants to, which means that the first parameter of the exception is met. And also, it is unlikely that the temporary difference reverse in near future, right? We say that it is probable that the temporary differences will not reverse in near future. And that is what is the idea of looking at this scenario. It is unlikely that the temporary differences will reverse in near future. And in this scenario, this situation is expected to have been met, which means that with the given information that this taxable temporary difference would not result into any DTL recognition. By virtue of that exception, this is what we need to conclude, right? Let's have a look at the formal solution of that. We are given that as the tax base of investment is the acquisition cost, which is 3,000 crores, as against the carrying value of 3,375, which we already mentioned, of course, in the books of Alpha Limited. There's a taxable temporary difference of 375 crores, right? Since alpha has 100% control or 100% shareholding in beta, it controls beta limited, and it is expected that it will be in a position to control the reversal of these temporary difference by means of having a control over the dividend policy of beta limited, right? That simply means that no deferred tax liability should be recognized as an exception. As an exception, no deferred tax liability should be recognized on the difference unless it is probable that this temporary difference will reverse in the near future or a foreseeable future. We are given this scenario where it says that on 1st of January 2015, Alpha Limited acquired 40% shareholding in Gamma Limited, which makes it an investment in associate for a consideration of 1500 crores. As at 31st of March 2020, Gamma Limited has made post-acquisition profits of 125 crores, which is undistributed. Simply means that Gamma has not paid any dividend of this profit. As per the tax jurisdiction, the tax base of the investment in Gamma Limited is the original acquisition cost. That is, of course, 1500 crores. The dividend distribution tax is given at 15%. The question's requirement is explain the tax consequences arising out of above. Now, with the given information, you would like to kind of pick this wherein we are provided that the tax base is 1500 crores. It's a clear information, right? I would like to compare that with the carrying value. The carrying value, which is, of course, the cost plus the share of profits, right? Alpha has acquired 40% stake in Gamma, and Gamma has made a post-acquisition profit of 125 crores, which means that on this 125 crores, 40% belongs to Alpha, right? And an investment in associate is measured at the cost plus the share of profits. That makes it 1550 crores. Okay. Now, with the carrying value of 1550 crores and a tax base of 1500 crores, this essentially results in a taxable temporary difference of 50 crores because my carrying value is more than the tax base, right? Now, if you go back on the exception to the recognition of a deferred tax liability, the exception mentions that if the investor has the power to control the reversal of the timing of the taxable temporary difference. Right? If the investor has the power to control the reversal of the timing of the taxable temporary difference, only in that case you cannot recognize a deferred tax liability. All right. In this scenario, we can safely assume that since this is an investment in associate, the control does not exist, as in Gamma can distribute the dividend as per its need or as per its policy, as per its decision. Okay. And that is where Alpha would probably not have a control as far as the distribution of dividend, which is nothing else but the timing of the reversal of the timing of the taxable temporary difference is concerned, right? Which means that on this taxable temporary difference, we must recognize a deferred tax liability, which is calculated at 50 into 15%. That makes it, of course, 7.5 crore rupees. All right. Let's have a look at the formal solution. We are given that in the books of Alpha Limited, investment in Gamma Limited is a carrying value of 1550. We've already done that calculation. It's 1500 plus 125 crores into 40%. The tax base of the investment is 1500 crores, which is its acquisition cost. This results in a taxable temporary difference of 50 crores. Since Gamma Limited is an investment in associate, it is likely that Alpha does not have a control over Gamma, and accordingly, it cannot control the reversal of the timing of the taxable difference. Which means what? Alpha Limited should recognize a deferred tax liability on the 50 crores. The rate is given at 15%, which means that a deferred tax liability of 7.5 crores will need to be recognized. All right. Thank you very much. We are provided the information which says Good Luck Limited has acquired a machinery for a cost of 1,000, which is a useful life of 5 years, and depreciation is charged under straight line method. However, the tax laws provide a depreciation rate of 25%, which is again straight line for the machinery. The corporate tax is 30% for 5 years. Assume no salvage value. The requirement of the question is explain the deferred tax impact for all these 5 years. Okay. Now, essentially, we need to do a lot of calculations around it, but it should not be difficult for us because if I look at my carrying amount, right? Let's refer to years 1, 2, 3, 4, and 5. I'm provided with the cost of the asset and depreciation as per books. This is 1,000. Let's call it accumulated depreciation. Right? My useful life is 5 years, which means that my annual depreciation has to be 200. Okay? Which makes this as the calculation. So annually, this is 1,000. We are given the information. Good Luck Limited has acquired a machinery for a cost of 1,000 rupees, which is a useful life of 5 years. Depreciation is charged under straight line method. However, tax laws provide a depreciation rate of 25% straight line method for the machinery. The corporate tax rate is 30% for 5 years. Assume no salvage value. Now, the question's requirement is explain the deferred tax impact for all 5 years. The approach for this kind of a question is I have an asset in my books, and considering the requirement, which is the deferred tax consequences for all these 5 years, I need to compare the carrying amount and the tax base for the machinery, right? We would remember the tax base of an asset is the amount that is deductible for tax purposes in future, right? So just need to remember that aspect and we'll proceed with that thought now, right? So what I'm going to do is basically just bring those listing of years, which is 1, 2, 3, 4, and 5. Now the cost of the asset is given to us as 1,000. So let's list it across. Now, as per books, right, I would need to calculate my accumulated depreciation as per my books, right? My useful life was given at 5 years, this one, and the depreciation is charged in the straight line method, which means that my depreciation for year 1 will be 200, and it would be 200 each year, which means that the accumulated depreciation would keep on increasing by 200 every year, which means that the carrying value at the end of year one is 800, year two is 600, year three is 400, year four is 200, and year five will be 0. Right? That's a straightforward calculation. Now, we say that the tax depreciation is basically given to us as 25% straight line method, which means that my accumulated depreciation, my accumulated tax depreciation will be 250. Second year it becomes 500. Year three it becomes 750. Year four it becomes 1000, and of course it is 1000 at the end of year five as well. Right? We don't charge any further depreciation beyond the cost of the asset, which means that my tax base will be 750 at the end of year one, 500 at the end of year two, 250 at the end of year three, 0 at the end of year four, and 5 respectively. All right. So let's even pick these numbers like this. Now, simply I would compare the carrying value with the tax base. And as we observe that in this case, and for that matter, in each of the years up to year four, the carrying value is more than the tax base. It results into a taxable temporary difference, which is 50. It becomes 100. It becomes 150. It becomes 200, and it becomes 0. All right. Now, we simply just need to calculate what is my deferred tax liability on each of these amounts. We are given the tax rate at 30%, which means that my deferred tax liability should be at the rate of 30%, it should be 15, 30, 45, 60, and it has to be 0 at the end of year 5, right? So the way we do the the measurement of the deferred tax or the calculations of the deferred tax liability is done in this particular manner. All right, let's have a look at the formal solution. The accounting base or the carrying value is of course calculated the same way we have done it just a while ago. Gross block, accumulated depreciation, and the carrying value is calculated. The tax base, again, we've done a similar calculation. Gross block, accumulated depreciation. The difference between the two is the tax base. Of course, it results into a deferred tax liability, right? And the taxable temporary difference is 50, 100, 150, 200. And of course, it reverses entirely at the end of year 5. And my deferred tax liability is calculated at 15, 30, 45, 60, and eventually it becomes 0. All right. Thank you very much. We are now given the scenario. Reality Limited has been established during the year with its first reporting period ending on 31st of December 2019. The below mentioned are the temporary differences. Accelerated depreciation resulting into taxable temporary differences of 90,000. Reality Limited expects these to reverse over the next 3 years at 30,000 per year. Expense disallowance resulting in deductible temporary difference of 40,000 expected to reverse over next 4 years, which is 10,000 per year. Reality Limited does not anticipate any profits over the next 5 years. The corporate tax rate is given as 30%. The tax rules permit carry forward of losses. The question says determine the deferred tax impact under Ind AS 12. Now, in a very simplistic manner, we can argue that if there is a taxable temporary difference of 90,000 and there is a deductible temporary difference of 40,000, we can create a deferred tax liability on this 90,000, which is 27,000. Likewise, on this 40,000, we can create a deferred tax asset at the rate of 30%, which would come, of course, 12,000, right? But the problem is something else. The challenge that we are facing is that do we have sufficient taxable profits during these 4 years, wherein these DTAs would be recoverable, wherein this deductible temporary differences would be reversed. Okay. Now, as far as a reversal of a deductible temporary difference is concerned, it is either available through a taxable profit or a taxable temporary difference, right? The duration that we are provided with is 4 years as far as those deductible temporary differences reversals are concerned, right? So if I were to look at that information and I put it on a in a tabular format, we are saying year one, year two, year three, and year four, right? Now, as far as my taxable temporary differences are concerned, we are seeing a reversal of 30,000 in the first 3 years. However, for the deductible temporary differences, we have reversals expected over next 4 years, right? Now, what does it imply? It implies that up to year three, my taxable temporary difference and deductible temporary difference are both available, and I have an opportunity to set off these deductible temporary differences against these taxable temporary differences, right? So out of 40,000, I have an opportunity to reverse to the extent of 30,000 of those deductible temporary differences. But the moment I look at the year four, right, this 10,000 of deductible temporary difference, which is getting reversed, there is no opportunity to adjust it against any taxable temporary differences reversals, right? So do I have any profits against that? Again, the answer is no, because it is provided that the company is not expecting any profits over the next 5 years, right? That means actually I need to create a DTL on this entire 90,000, which is 27,000, right? But the DTA can only be created on 30,000, which is the first 3 years of reversals of those deductible temporary differences, right? So I will have a DTL of 27,000, which is 90,000 into 30%. And as far as the DTA is concerned, I can only create a DTA as on 31st of December. So let's put it as on 31st of December 19. I can only create a DTA of 9,000. All right. The only option that we want to highlight here further is that if Reality Limited has any tax saving or tax planning opportunities, right? Only if there are tax planning opportunities available, this particular DTA may be created on this entire 40,000 there. All right. Let's have a look at the formal solution. We are provided that accelerated depreciation, the information on accelerated depreciation, Reality Limited should recognize a deferred tax liability on the taxable temporary difference, which is of course 27,000. As far as the expense disallowance is concerned, we are provided the deferred tax asset should be recognized if an entity expects sufficient taxable temporary differences or taxable income which will be available against which the DTA can be set off or reversed. Since Reality Limited estimates losses for the next 5 years, DTA should only be recognized to the extent of reversal of taxable temporary differences on that accelerated depreciation, which means I can only recognize the DTA reversal to the extent of 30,000 and not 40,000, right? This would mean that my DTA to be recognized should be 30,000 into 30%, which is 9,000, right? Which obviously the conclusion is no DTA should be recognized for the reversal of deductible temporary differences for the year ended 31st of December 2023. Now, this is year 4, of course, right? Since Reality Limited is expecting losses and there are no taxable temporary difference for offsetting purposes. However, if Reality Limited expects to implement tax planning strategies for that year, only in that context a DTA should be allowed to be recognized on that remaining 10,000 rupees